So think about this. There's this huge demographic wave hitting us, right? And it's creating this really critical market opportunity. It's not just theory. It's happening right now.
Mm.
In senior living. Today, we're doing a deep dive into this market, specifically focusing on what some people are calling the senior living boom that seems to be really taking shape in Indiana.
Absolutely. And for this deep dive, we've gone through, well, a lot of material for the latest reports, market notes, expert takes. Our goal here is really to help you get up to speed fast. Why is senior living occupancy suddenly surging? And how is this asset class, which honestly often gets overlooked, now grabbing serious attention from multifamily investors? Plus, why Indiana? Why is that the place emerging as such a key market? So consider this your shortcut to really understanding what's going on in a sector that's, frankly, on the verge of a major shift.
Okay, let's unpack that. Starting with the big picture. America's population is aging fast. I mean, the statistic is pretty staggering, over 10,000 baby boomers turning 65 every single day. And that's more than just a number. It feels like a fundamental change in society.
It really is. And the scale is just immense. Take the 80-plus group, for example. Projections show that demographics surging by, get this, 47% to nearly 21 million people by 2035. That's not a small adjustment. It completely changes the landscape for housing and care needs.
In Indiana specifically seems to be right in the thick of it. Our sources show, 16.7% of Hoosiers, that's 1.1 million people already 65 or older, and that's expected to hit 20% by 2030, especially in places like Indianapolis and Fort Wayne. The demand is clearly building there.
Which naturally leads to the big question. If demand is surging like that, where are all these seniors going to live? The industry needs somewhere between 35,000 and 45,000 new units every year, just to keep up. But in 2024, construction starts were incredibly low. Only about 700 units broke ground. That's the lowest in over 10 years. A huge drop, like 40% from the year before. So what does that mean long term? It means by 2027, we're staring down a nationwide shortage of around 250,000 units. It's a massive supply gap.
Wow. Okay, so if the demand is this tidal wave, why isn't development keeping pace? What are the main things holding back construction?
That's really the million-dollar question, isn't it? And it's like a perfect storm of factors, really. You've got high interest rates, first off. Construction loans are running 7–8%. Ouch. Then major labor shortages. Something like 30% of contractors are reporting delays just because they can't find skilled workers. And of course, rising costs for materials. Steel alone is up 15% since 2022. Any one of those is tough. Put them all together. It makes building incredibly difficult right now.
A perfect storm indeed. So you have these bottlenecks on the supply side, but the demand is clearly there and it's not really optional for many people. What's the result?
Well, yeah, when you have that kind of squeeze limited supply hitting this huge non-negotiable demand, it definitely becomes a landlord's market. But it's almost more than that. It feels like a fundamental shift, maybe a recalibration in how the market views this whole asset class. Like it's finally recognizing the stability that senior living has always had,
Yeah.
that bedrock need. So directly you see occupancy rates climbing, rents going up, and that creates huge potential, especially in states like Indiana, where maybe the barriers to build are a bit lower than, say, on the coasts.
Right. So thinking about that demand and supply picture, the next logical question for you listening is probably, okay, what does this mean if I'm an investor? And the numbers are really telling a story here. Senior living occupancy hit 86.5% in Q3 2024. That's 13 straight quarters of gains. 13.
Yeah.
That's a really strong, consistent trend.
Yeah, nationally it's huge. We're at a record high 611,000 occupied units across the country. If you break it down, independent living is leading the pack at about 87.6% occupancy. But assisted living, which is at 84.3%, is actually bouncing back faster after COVID. And that seems to be driven by really needs-based demand, especially for dementia care, which is growing.
You see some markets that are just incredibly tight. Boston at over 91% occupancy, Tampa near 90%. And like you mentioned, Indiana's not far behind. The Indianapolis metro area is around 88% for stabilized properties. So Indiana's holding its own, even against those traditionally strong markets.
Exactly. And if you tie it back to the core drivers, it's pretty clear it's the lack of new supply. Construction starts just fell off a cliff, down 70% from the peak in 2019. We went from 70,000 units then to just 31,000 in 2024. Meanwhile, the number of units getting filled, the absorption is consistently over 35,000 per year. So there's this ongoing basic imbalance. We're filling them faster than we're building them.
Okay, so we've got the national picture. Let's zoom back into Indiana and really look at its specific situation. Fort Wayne, for instance. Its 65-plus population grew 18% between 2015 and 2023. That's significant growth. and their senior living places are running at 88%, maybe even 90% occupancy. But get this, only 10 new communities were added in that entire time. 10. It just hammers home how much the demand is outpacing the supply right there.
And looking forward, projections suggest we could see national occupancy hitting 90% by late 2025. With rents climbing 4 or 5% a year, especially in markets like Indiana where there just aren't enough options, it really highlights senior living as what we call a need-driven asset class. Think about it, you know? Other types of real estate might dip during a recession, but the need for care, for housing for older adults, that doesn't just disappear. That fundamental need makes it uniquely resilient, almost counter-cyclical, you could say, a safe harbor when other markets get chalky.
Okay, so that resilience, the strong demand, it really leads to a fascinating question. Why are traditional multifamily investors, people who usually stick to apartments, suddenly paying such close attention to senior living? What's the big draw?
Well, one of the most compelling things, I think, is that senior living operates as this kind of hybrid. It mixes the residential stuff you see in apartments, units, pools, fitness centers with hospitality services, and think dining, transportation, and then crucially, it layers in healthcare, nursing support, therapy, that kind of thing. Especially the active adult communities, the 55 plus ones, they look a lot like traditional multifamily. So for an investor, it offers scalability, but maybe with fewer regulatory headaches than, say, skilled nursing. It feels like a natural step for them.
That makes a lot of sense. It's like multifamily plus with essential services built right in. Okay, let's talk money. How do the returns, the cap rates, actually compare? Senior living versus regular apartments. Oh, the financials. Yes, they are definitely eye-catching. Senior living cap rates, and just quickly, that's basically the potential return rate on the investment. They typically range from 6.5% up to 9.5%. Compare that to multifamily, which is usually hovering around 4.5% to 5.5%. So you're looking at a premium of almost 2, maybe 2.5 percentage points. In finance terms, that's 190 to 260 basis points. It's significant. Let's take an Indiana example. A solid, stabilized assisted living place might give you an 8% cap rate. Meanwhile, a nice Class A apartment building in Indy is probably closer to 5%. On average across the board, assisted living is around 7.6%. And memory care, because it's so specialized, can get up to 9.5%. So if you're an investor, just picture that, right? Yeah. Much higher potential returns for something that's fundamentally needs-based and pretty resilient. It's almost a no-brainer, isn't it? It really does sound compelling. And there's another angle too, right? Opportunities from distressed assets. I think our sources mentioned something like $10 billion in loans coming due in 2025. Yeah. That could shake things up.
Oh, absolutely. That wave of loan maturities could definitely create buying opportunities and investor sentiment. It's incredibly positive right now. A CBRE survey from 2024 found 90% of industry leaders plan to increase their investment in senior housing in 2025. They're focusing mostly on core plus, basically improving existing stable properties, but also quite a bit on opportunistic plays, which are maybe higher risk but higher reward. The whole sector is projected to grow to nearly $160 billion by 2030. That's a steady growth rate of almost 6% a year, compounded. And for Indiana specifically, the appeal is strong. Land is cheaper, like $50K to $100K an acre, maybe half the price of coastal areas. Plus, the state seems pretty supportive from a regulatory standpoint. And there's an ESG angle, too. Investing in quality care and sustainable building designs checks those boxes for many investors.
All these threads really seem to weave together to put Indiana in a prime spot. Demand is definitely surging. 1.1 million residents, 65 plus now, potentially 20% growth by 2030, especially around Indy, Fort Wayne, Lafayette.
And that growth directly impacts the current supply situation within Indiana. The state has, about 120 senior living communities. And while occupancy is high, 85% in assisted living, 90% in independent living, it's clear they just can't keep up. The rate people are moving in is just outpacing any new construction by quite a bit.
Okay, but even with all this overall demand, our source pointed out something really interesting, a big chunk of the market that's actually being missed. Who are we talking about?
Yeah, it's fascinating. We're talking about the middle market. These are seniors roughly in the 41st to 80th income percentiles. And that group makes up about 60%, huge majority of Indiana seniors. Yet only around 15% of the senior living units currently available are priced for them. It's this massive gap, sometimes called the missing middle, a huge underserved population.
So if that opportunity is there, why is Indiana a particularly good place to build for that middle market? What makes it cost effective?
Well, a big piece of it is the development cost. Land prices, like we said, are significantly lower, maybe 20–30% less than in really hot markets. And Indiana offers some helpful tools like tax incentives. Think TIF districts, tax increment financing, where basically the future property taxes generated by a new project help pay for that project itself. It streamlines things. Plus, the state's Medicaid waiver program is important. It helps make assisted living more affordable for some residents, which supports demand and makes these projects more financially sound.
But, it can't all be sunshine and roses. It's easy to get swept up in the opportunity, but what are the real hurdles on the ground? Staffing seems like a huge one. 25% vacancy rates for nursing assistants. That's tough. And insurance costs going up 10% last year adds pressure too. It really sounds like having the right partners, experienced operators, is absolutely critical to make these deals work.
No doubt, it's complex. And when you look at the specific cities, Indianapolis with its high occupancy and Fort Wayne seeing that big jump in seniors, they really pop out as key areas. But don't overlook secondary cities like Evansville or South Bend. Especially for those middle market projects, you might find less competition there. And this is where specialized expertise becomes so valuable. Our sources actually mention folks like Cara Conde, who focuses specifically on Indiana's commercial senior living market. Her value, based on what we read, seems to be in that data-driven approach, finding those sweet spots, high demand, low competition submarkets, and connecting investors with the right operators, the ones who know how to actually navigate staffing and costs and make these projects succeed.
Right. It's not just about finding a property. Okay, so beyond the current market, what's next? What innovations are shaping the future of senior living, say, for 2025 and beyond?
Well, one trend gaining steam is adaptive reuse, taking buildings like vacant malls or empty office parks and converting them into senior living. That can seriously cut costs, maybe 20–30%, and shave 6–12 months off the timeline. Really interesting for suburban areas in Indiana with those kinds of empty commercial spaces.
And modular construction, too. That sounds promising for speed and cost.
Exactly. Modular can potentially cut build times by 25% and cost by maybe 15%. That gets units online much faster. Then there's tech, lots happening there. AI helping with health monitoring, smart sensors in rooms that can improve care but also potentially reduce staff workload by around 15%. And better CRM systems, customer relationship management, helping facilities boost their lead conversion by up to 30%, keeping those occupancy rates high.
And that middle market gap we talked about, it keeps coming up. Still, only about 10% of units nationwide are really targeting that $2,500 to $4,000 a month price point, even though in Indiana, 60% of seniors fall into that income range.
Yeah.
It's just such a disconnect.
It really is, but solutions are emerging. We're seeing more interest in mixed-use communities. Imagine senior living integrated right alongside retail shops or healthcare clinics. It creates more vibrant places for residents and can be more appealing to investors, too. Kind of like building a small neighborhood. Sustainability is also big. Solar panels, super efficient HVAC systems. These attract the big institutional investors and can cut operating costs by 10–15% down the road.
Okay, but let's circle back to that staffing challenge because it seems so fundamental. I mean, 20–30% vacancy rates for caregivers. That's a constant struggle for providers, often tied to wages around $15–18 an hour and just sheer burnout. How are people tackling that?
Yeah, it's probably the toughest nut to crack. But solutions are being tried. Things like AI for smarter staff scheduling, expanding telehealth to reduce the load on in-person staff, and creative public-private partnerships, leveraging things like Indiana's Medicaid waivers to maybe improve training or pipeline programs. On the cost side, operators are looking at things like buying supplies centrally for multiple facilities or doing energy retrofits to save 5–10% on utilities. Every bit helps free up cash, potentially for wages. So let's try to pull this all together. What's the bottom line here? The senior living sector is offering this really rare convergence of factors. You've got record high occupancy, 86.5%, and climbing fast towards 90%. You have a severe shortage of supply. Remember that 250,000 unit gap projected by 2027. And you have these really compelling cap rates, 6.5% to 9.5%, that are making multifamily investors sit up and take notice.
And Indiana specifically really does seem like a hidden gem in all this. You've got the growing senior population, land is relatively affordable, and there's that huge underserved middle market. It just ticks a lot of boxes, really seems ripe for growth.
Definitely. The numbers paint a clear picture, a booming market, occupancy going up, strong returns. But, stepping back from the spreadsheets for a second, we're talking about creating homes, communities where our parents or grandparents, where we might live eventually. So maybe the final thought to leave you with is this. Beyond the opportunity, how do we make sure that profitability goes hand in hand with purpose? How do we build places that offer real dignity, real connection, real joy for the people living there now and for the generations coming up? That's probably the most important question, isn't it?